Warren Buffett is sitting on $350 billion in cash right now. That's more than the GDP of most countries. This striking move mirrors his strategy right before the dot crash that devastated countless investors. What's Buffett seeing that others aren't? If the Oracle of Omaha is stockpiling cash at this scale, what signals is he reading in today's market? The warning signs are clear. The Buffett indicator stands at 177%, well above the danger zone of 100%. And the Shiller P/E ratio is double its historical average. The real question becomes, how can you protect your wealth if market conditions deteriorate as Buffett seems to anticipate? The market conditions we're seeing today look remarkably similar to those right before the dot bubble burst in 2000, wiping out trillions in wealth. Buffett isn't making random moves. He's responding to specific warning signs that have accurately predicted market trouble in the past. Two key metrics guide Buffett's market temperature readings. The first is what financial analysts now call the Buffett indicator, the total market value of all U.S. companies divided by the country's GDP. It measures whether the stock market is reasonably valued compared to the actual economy. Buffett himself stated in 2001 that this ratio is probably the best single measure of where valuations stand at any given moment. Think of it like a car's temperature gauge. When it reads too high, the engine risks overheating and breaking down. The second metric is the Shiller P/E ratio, or CAPE, cyclically adjusted price-to-earnings ratio. This takes the current price of the S&P 500 and divides it by the average company earnings over the past decade, smoothing out temporary fluctuations for a clearer picture of true market valuation. What's concerning is where these indicators stand today. The Buffett indicator currently sits at 177%, meaning the stock market is valued at nearly double the size of the entire U.S. economy. For context, anything above 100% has historically been considered the danger zone. Even during the height of the dot-com bubble, this indicator only reached 140%. Meanwhile, the Shiller P/E ratio has climbed to approximately 33, more than double its historical average. When this ratio exceeds 15 to 16, market experts consider stocks to be entering potential bubble territory. These are flashing red alerts. But what if history is trying to warn us again? In the late 1990s, both indicators reached extreme levels, though not as high as today. What followed was a lost decade for investors. From 2000 to 2012, the S&P 500 delivered an annualized return of only 2%, less than the rate of inflation. Investors actually lost purchasing power despite staying invested for over a decade. During this period, even traditionally boring investments like bonds and dividend-paying stocks significantly outperformed the broader market. Investors who ignored the warning signs suffered the most. Today, we see similar warning lights. Buffett's response mirrors exactly what he did in 1999. Back then, he chose not to buy stocks and even refused to repurchase shares in his own company. Instead, he built up cash reserves while others rushed to buy overpriced assets. Today's market shows bubble-like behavior in specific sectors. Technology and AI stocks have seen valuations detach from traditional metrics. The Magnificent Seven tech stocks now represent an unprecedented concentration of market value in just a handful of companies. Social media is filled with stories of overnight millionaires from meme stocks and cryptocurrencies, creating a fear of missing out that drives more speculation. This matches the environment of 1999 when taxi drivers were giving out stock tips and anyone not fully invested felt left behind. Buffett's indicators suggest we may be heading for either a significant market correction, potentially 30 to 50% for overvalued sectors, or an extended period of poor returns as valuations gradually normalize. The question becomes, what exactly is Buffett doing with his money in response? With $341 billion in cash, more than the GDP of countries like Denmark or Thailand, Buffett is making a clear statement about risk versus reward today. Understanding his defensive playbook might help us navigate challenging times ahead. The market has been delivering double-digit returns. So why would Warren Buffett choose to earn just 4 to 5% in treasuries? This question gets to the heart of Buffett's investment philosophy: patience, discipline, and a focus on long-term value. Berkshire Hathaway is currently sitting on a staggering $350 billion in cash. This enormous sum represents over one-third of the company's total value. The greatest investor of our time has chosen to keep more than 33% of his company's assets in cash equivalents rather than stocks during one of the strongest bull markets in history. This conservative stance stands in stark contrast to the general market enthusiasm we're seeing today. While retail investors are piling into stocks, chasing the latest AI trends, and worrying about missing out on gains, Buffett is moving in the opposite direction. He's systematically increasing his cash position quarter after quarter like a seasoned sailor seeking safe harbor while others race their boats toward the horizon oblivious to brewing storm clouds. Buffett is managing this mountain of cash by purchasing short-term U.S. Treasury bills, yielding between 4 and 5% annually. These investments provide a secure place for Berkshire's capital while generating modest but guaranteed returns. In today's high inflation environment, these yields at least help preserve purchasing power while Buffett waits for better opportunities. This approach mirrors exactly what Buffett did in 1999 before the dot crash. Back then, he also avoided buying stocks and accumulated cash even as the market continued to rise. In his 1999 shareholder letter, Buffett warned that equity investors seem wildly optimistic in their expectations about future returns. He predicted a difficult period ahead for investors, and he was right. The market returned an annualized return of only 2% from 2000 to 2012, less than inflation, resulting in what many call the lost decade of investing. By maintaining such a massive cash position, Buffett is positioning himself as the buyer of last resort when others are forced to sell. When markets eventually correct, as they historically always do, Buffett will have the financial firepower to acquire high-quality assets at fire sale prices. Imagine being in a position to buy quality assets at a fraction of their regular cost when the market cools down. This is the opportunity Buffett is patiently creating. During the 2008 financial crisis, Buffett was able to secure preferred shares in companies like Goldman Sachs and Bank of America with guaranteed dividends plus stock warrants. These crisis-era investments generated billions in profits for Berkshire shareholders. His current cash pile would allow him to make similar moves on an even larger scale during the next market dislocation. Buffett is sacrificing short-term gains for safety and optionality. He's positioning himself to capitalize on future market dislocations that may offer far better risk-adjusted returns than today's elevated valuations. As he famously said, "Be fearful when others are greedy and greedy when others are fearful." Right now, Buffett clearly sees greed dominating the market. While we can't predict exactly what opportunities Buffett is waiting for, his patience demonstrates a fundamental principle of successful investing. You don't need to swing at every pitch. Sometimes the best move is to wait for the perfect opportunity when the odds are significantly in your favor. Buffett's strategy is to be patient and wait for the spring blowout sale to go shopping and fill up his portfolio with a new batch of companies. But what does history tell us about Buffett's track record when he takes this defensive stance? His previous periods of cash accumulation have preceded some of his most successful investments. When the stock market is booming, Buffett's cautious approach often seems outdated. But history has repeatedly shown that when Buffett gets defensive, it's worth paying attention. His pattern of stockpiling cash before major downturns isn't coincidental. It's a deliberate strategy that has generated enormous wealth. This pattern has repeated throughout Buffett's career with two notable examples, the dot bubble and the 2008 financial crisis. Before the dot crash, Buffett accumulated substantial cash while lamenting the lack of reasonably priced investments. He watched as internet companies with minimal revenue commanded massive valuations and simply refused to participate. When the bubble burst in 2000, the Nasdaq lost nearly 80% of its value and the S&P 500 fell by almost 50%. Buffett, having preserved his capital, deployed cash into companies at reasonable valuations while others nursed their wounds. Similarly, during the 2008 financial crisis, Buffett had built Berkshire's cash reserves as housing prices climbed unsustainably. This preparation enabled him to invest $5 billion in Goldman Sachs, receiving preferred shares with a 10% dividend yield plus warrants. By 2013, this position generated a profit of approximately $3.7 billion. His $5 billion Bank of America investment in 2011 yielded preferred stock plus warrants that eventually created over $12 billion in profit by 2017. The patience to accumulate cash during overvalued markets transforms an investor's financial trajectory. Being prepared when others are desperate creates extraordinary opportunities. As Buffett wrote in his 1999 shareholder letter, market psychology during bubbles resembles Cinderella at the ball. Just like Cinderella knew the clock would strike midnight, but squeezed in one last dance, investors often recognize overvalued markets, but can't resist chasing final gains before the inevitable crash. The mathematical advantage of having cash during downturns is compelling. When a stock drops 50%, it needs to gain 100% just to recover its original value. It's like needing a double dose of fuel to get a car back on track after running on empty. However, an investor with available cash can purchase twice as many shares at the lower price, requiring only a 50% recovery to double their money. This asymmetry creates tremendous wealth building potential during market corrections. Buffett's approach differs fundamentally from market timing. He doesn't predict exactly when markets will peak or bottom. Instead, he focuses on the relationship between price and value, accumulating cash when prices significantly exceed intrinsic values, and deploying that cash when values exceed prices. This strategy requires recognizing when odds are unfavorable and having discipline to wait for better opportunities, like a professional card counter who adjusts bets based on the odds. For average investors, the lesson is understanding the power of maintaining some dry powder when valuations reach extreme levels. Having cash during market corrections allows you to purchase quality assets at discounted prices, like shopping during a clearance sale rather than paying full price. History suggests that Buffett's current cautious stance likely precedes opportunities to acquire quality assets at significant discounts. While no one can predict exactly when the current market cycle will end, Buffett's massive cash position speaks volumes about his assessment of today's risk-reward balance. So, how can you apply Buffett's approach without having billions in the bank? The challenge for most of us is that we don't have Berkshire Hathaway's resources or Buffett's investing genius. But the principles behind his strategy can be adapted for individual investors like you and me. The biggest obstacle many investors face isn't knowledge but psychology. The fear of missing out drives decisions. Consider Tom, a client I once worked with who kept his portfolio fully invested during 2007 despite warning signs because everyone at his office was bragging about their gains. By 2009, he'd lost 45% of his retirement savings. FOMO causes investors to stay fully invested even when markets appear overvalued. We prioritize potential gains over protecting against losses. Overcoming FOMO isn't easy, but here's how you can channel Buffett's wisdom into your strategy. 1. Gradually increase your cash position as market valuations become extreme. When the Buffett indicator exceeds historical norms, currently 177%, consider this your caution signal. 2. Adjust your cash allocation based on your situation. Younger investors, 10 to 15% cash reserve during extreme valuations. Near retirement, 20 to 30% or higher. Make these adjustments gradually, not all at once. 3. Park your cash strategically. Buffett uses short-term U.S. Treasuries yielding 4 to 5%. Individual investors can buy Treasury bills through treasurydirect.gov minimum $100. High-yield savings accounts and money market funds offer similar yields, providing liquidity while offsetting inflation. Your cash reserve provides 3 key benefits. Reduced exposure to market downturns, psychological comfort during volatility, and ammunition to capitalize on opportunities when quality companies go on sale. Remember that your income remains your greatest wealth building tool. Investing in career development can generate returns exceeding what's possible in financial markets. A 10% salary increase consistently invested over your career can add hundreds of thousands to your retirement savings. Far more impact than most market timing decisions. A complete strategy for today's uncertain markets combines regular investments through dollar-cost averaging, strategic cash building as valuations become extreme, career investment to increase your income, patience to wait for genuine opportunities. The real insight from Buffett's positioning is about preparation, not prediction. Building cash reserves when markets are expensive positions you to act when genuine opportunities emerge. You don't need to predict exactly when markets will turn. Just recognize when odds aren't in your favor. Sarah, another investor I worked with, maintained a 25% cash position through 2019 to 2020. When markets crashed in March 2020, she deployed half her reserves into quality companies at steep discounts. By 2021, those investments had doubled, while her friends who panic sold were still recovering. A disciplined approach combining consistent investing with strategic cash building positions you for long-term success regardless of short-term market movements. As Charlie Munger said, the big money is not made when you buy a stock, and it's not made when you sell a stock. It's made in the time you hold and wait. Wealth building isn't about chasing trends or perfect timing. It's about being realistic, patient, and prepared to act when genuine opportunities arise. Buffett's $350 billion cash position speaks volumes about his investment philosophy. It's about being prepared for opportunities. This massive cash reserve represents patience and discipline in action. Two qualities that separate successful investors from the crowd. What we can learn from Buffett is that wealth building requires patience. The big money comes from holding and waiting, not from buying or selling at the perfect moment. If you found value on this video, like, share and subscribe. The best investment strategy prioritizes realism and readiness for genuine opportunities. Embrace Buffett's patience today as your roadmap to long-term success, and you'll be primed for opportunity tomorrow when others panic.